Yeah, guys, I don't think this is it. And usually, listen to this, statistically, historically, the first decline, the first crack in a market is usually not the serious one. So think about this. This first crack from the top was the most accelerated, was the fastest 10% drop in the history of the world. And that's saying something, right? But it's usually not the first one that's the serious one. So if we take history into accord, then we've got a secondary drop after some type of break, after some type of pause, after some type of temporary move back to the upside maybe, that then really starts the whole thing. And so if history's any guide here, we haven't seen anything yet. You understand? So just think of how a ball drops, right? So a ball drops, hits the pavement, bounces up. But there's a secondary drop there. Boom. But that bounce up, what makes the second drop historically bigger and more serious than the first one is because the first drop creates a what some people regard as a bargain. So the people who missed out on the incredible bull market, the people who were kicking themselves while everyone else was making money, they see the first drop as an opportunity, especially when the market starts to rebound, the ball starts to bounce back up, right? They're like, it's finally my chance, I'm going in. So more people actually go in after the first crack. And that sets up the market for more sellers. The more people who buy means that you have more people in the future who will be sellers, right? Sellers are former buyers, right? So if you get more buyers, that means that in the future you have more sellers. So the first drop creates more buyers, which increases the pool of people who are going to sell everything on the second scariest drop. And it's a self-fulfilling prophecy because as it drops lower, more and more people become losers. So for instance, let's take $100 stock. Well, people who bought at 70, if the stock drops from 100 to 80, the people who bought at 70 are still not losers. They've lost profits, but they haven't lost original capital, right? But anyone who bought at 98 is a loser at 80. Anyone who bought at 90 is a loser at 80. So every dollar collects millions and millions more of losers. Because some people bought at 98, some people bought at 97, some people bought at 91, some people bought at 87, some people bought at 85. So every time it drops, it's picking up the number of losers. The number of losers losing original capital grows, and every few cents down, people say, I'm getting out because I'm a loser now, I'm getting out. And it just starts to feed on itself. Do you understand this? Does this scenario make sense to you? Remember, I just put a video out on my YouTube channel today. We're not trading companies, we're trading people. When you start to look at the market from the personal point of view, from the psychological point of view, it starts to make sense. When you try to understand it from PE ratios and sales ratios and products and company management and industry dominance and that's just stupid. And I know that's the stuff that Warren Buffett talks about, but guys, look, we're not Warren Buffett and we never will be. That's not how we're supposed to play the market. You know, we play people. And when you think of it from the personal aspect, what's happening to people, this whole mystery starts to make sense.